Welcome to Course Dunya.
Key accounting principles. In key accounting principles, we have the two principles. One is a GAAP, generally accepted accounting principles. Second one, IFRS, International Financial Reporting Standards. This principle helps ensure that financial statements are prepared consistently and accurately, making it easier for investors, creditors, and other stakeholders to understand and compare financial information. So, this is the introduction about the key accounting principles, and we'll go in depth with one by one. First one is the GAAP, generally accepted accounting principles. In GAAP, we have the six principles. The first one will be the accrual basis of accounting. Second one, historical cost principle. Third one, conservatism principle. Fourth one, consistency principle. Fifth one, materiality principle. And the last one, matching principle. First one, accrual basis of accounting. So what is the accrual basis? Means whenever the transaction is happened without any payment, then it should be recorded in accounting. Like the best example is the credit. The definition is also the same. When transactions are recorded in the books of accounts as they occurred, even if the payments for that particular product or service has not been received or made. Second one, historical cost principle. So historical cost principle means nothing but if you purchase any asset, what is the price at the time of purchases, the same will be recorded in all the books. It will be not record the current market price. Okay, that is the historical cost. The definition is also same. Business records the original cost of an asset on their balance sheet instead of its current market price. Third one, conservatism principle. So conservatism principle means nothing but whenever the situation is happened, then we'll have the two types of ideas in our knowledge. And we should be take the idea which is getting the profitability. And the second one will be take the least action. That is the conservatism. The definition, which refers to the idea that expenses and liabilities should be recognized as soon as possible in a situation where there is uncertainty about the possible outcome, and in contrast record assets and revenues only when they are assumed to be received. That is the fourth one, consistency principle. So consistency principle means we are maintaining same standard, same principle throughout the academic year. Will be called as the consistency principle. That is, business should maintain the same accounting methods or principle throughout the accounting periods. That is called as the consistency principle. Fifth one, materiality principle. In the materiality principle means definitely we should have a document, because if you have any mistakes or any problems in the accountancy, so through the statements or to the reports, we can easily identify that. That is called as the materiality. The supporting document should be there. The definition determines whether a discrepancy, such as an omission or misstatement, would impact a reasonable user's decision making. That is the materiality principle. And the last one, matching principle. So that means will match with the earning and expenditure. The matching between the earning and expenditure, that is called as the matching principle. Based on the cause and effect relationship between spending and earning will be comes under the matching principle. IFRS, International Financial Reporting Standards. In these principles, we have the 6 principles. The first one, fair value measurement. Second one, prudence. Third one, going concern assumption. Fourth one, revaluation model. Fifth one, substance over form. Sixth one, comparative information. From these 6 principles, we can identify how the financial reporting standards will be worked. First one, fair value measurement. Fair value means whether if you want to sell your asset or if you want to transfer your liabilities to the other parties, it will be depends on the market condition only, not as per our convenience or as per the client convenience. It will be based on the market condition. Assets or liabilities is exchanged in an order transactions between market participants to sell the assets or transfer the liabilities at the measurement date under current market condition. Second one, prudence. So prudence means nothing but it's a proof, the ability to govern and discipline oneself by the use of reason. So that means whatever it is happened in the accounts, by the result we can able to understand that this should be not happen and this should be happen, so we can maintain ourselves as a discipline and we can follow the principles. That is third one, going concern concept. As usual, everyone knows about the going concept. That means the value should be in your long term. That will be called as the going concern concept. Financially stable enough to stay in business in the long term or at least beyond the next physical period. So that means our business should be sustained for the long time. It should not close within a short time. At least it should be for 2 years or 3 years, the next physical year. That is the going concept. The business should be increased day by day. Fourth one, revaluation model. So revaluation means, for example, if you have purchased any asset in the business, so every year the asset value will be decreased because due to its performance. So the value at the starting of purchases will be more, but year by year the value will be comes down. That is called as the revaluation method. And some assets will be there. At the time the value will be some and it will be increased. That is also called as the revaluation method. That is, a fixed asset is originally recorded at cost, but the carrying value of the fixed assets can then be increased or decreased depending on the fair market value of the fixed assets, normally once in a year. That is the revaluation model. Fifth one, substance over form. That means giving the clear picture of the accounts. That is the thing. To ensure that financial statements gives a complete, relevant, and accurate picture of transactions and events. That is the substance over form. And the last one, comparative information. So comparative information means the comparison between the mentioned and present value. So like in the previous, whatever the assets values you have been mentioned and what is the actual values, the comparison between both will be comes under the comparative comparison. Represents the amount and disclosures including in the consolidated annual accounts for one or more previous periods and provides the users with information necessary to identify trends and changes affecting an entity over a period of